Nickel is quietly shaping the blueprint of modern industry, from stainless steel that keeps kitchens and bridges rust-free to batteries powering electric vehicles and grid storage. Today, the nickel market is moving in a way that touches every consumer and investor, even if the metal stays mostly out of sight. Supply disruptions in traditional mines, political risk in major producers, and a chorus of analysts revising EV demand forecasts have combined to push prices higher and sentiment lower. In a world chasing green energy while juggling budgets, nickel sits at a critical crossroads where raw material reality meets financial risk. Nickel is a hard, silvery metal whose primary use is stainless steel and increasingly electric vehicle batteries. In steelmaking, nickel strengthens alloys without adding excessive weight, letting ships and buildings endure climate and corrosion. In batteries, nickel-rich cathodes boost energy density, which translates into longer ranges for EVs and more storage for renewable grids. Prices respond to mine output, purities, and the pace of downstream demand. Unlike oil, nickel cannot be burned for energy, but its price swings reflect supply constraints, smelter bottlenecks, and the cost of financing long mine development cycles. Investors watch inventories and deliveries, probing substitution in battery chemistries. Nickel has long braided its way through metal markets, first discovered for coins, then forged into stainless steel. The modern nickel saga centers on a handful of giant mines in Indonesia, Russia, and the Philippines, plus refining hubs in China and Europe. Indonesia, a dominant supplier, shifted from raw ore exports to processing cash flow in the 2010s, injecting volatility into global supply as smelters come online, and capacity races to catch up with demand. The storied Norilsk operation in Russia, shadowed by sanctions and logistics, reminds markets that geopolitical risk can widen price gaps faster than a stainless steel mill can adjust. Market metrics reflect the drumbeat of nickel realities. LME and SHFE inventories are watched like weather gauges, while refined nickel prices have traded in wide ranges as traders reconcile spot deficits with future supply. In recent months, premiums for nickel in stainless steel mills rose, signaling tightness at the point of use. Exchange-traded funds and producer hedges have grown more active, and large industry players forecast higher capex to sustain mine feeds. Consumers face higher stainless steel costs, automakers face battery price pressures, and investors see nickel as a proxy for the global tug between growth via electrification and the cost of capital. Within the corporate map, producers like Glencore, Vale, and Norilsk are balancing debt, capex, and supply obligations, while smelters in China, Japan, and Europe chase cooling costs and cleaner energy grids. End users in stainless steel, chemical processing, and battery manufacturers feel the squeeze as higher input costs ripple into products. Investors see nickel as a lever on inflation risk and EV adoption, prompting funds to tilt toward diversified mining equities or specialized exchange trades. Governments and policymakers weigh the environmental footprint of mining expansion, ensuring that growth does not outstrip social and ecological boundaries. Local communities and workers seek fair wages, safe operations, and transparent reporting. Geopolitics shapes nickel as surely as geology does. Indonesia rests at the center of supply, while Russia's war and sanctions complicate export routes and price transparency. Trade policy, currency volatility, and inflation dynamics influence the cost of financing new mines and shipping concentrate to smelters. China remains the dominant refining hub, so any disruption there moves global benchmarks. The transition to renewables and electric transportation creates a longer horizon demand story. But macro concerns like rising interest rates, government incentives, and fiscal deficits can muddy the timing of capex and project approvals. Investors monitor policy shifts, currency hedges, and trade chatter for clues. Smart money unfolds in a chorus of hedges, ETFs, and industrial capex forecasts. Large miners push forward expansion despite price volatility, while institutions rotate toward commodities with clearer downstream demand. ETFs linked to nickel have seen inflows as buyers bet on stainless steel mills and EV battery cathodes. Banks price risk through forward curves, and analysts publish scenario models where nickel either plateaus near current levels or breaks higher on supply bottlenecks. Retail traders increasingly discuss battery supply chains, while sovereign wealth funds review diversification benefits in a commodity mix that hints at a base case of gradual drift higher. Bear case risks hinge on demand and supply winds diverging. A sudden slowdown in manufacturing, policy pullbacks, or a global recession could trim stainless steel and EV demand, deflating prices. Alternatively, a supply shock ailer Indonesia's smelter ramp or a new battery chemistry's pivot toward lower nickel content could leave legacy producers with unsold concentrate. Environmental and permitting delays threaten project timelines, while financing costs climb with higher interest rates. Market liquidity could deteriorate if hedges unwind and low volumes amplify volatility, turning nickel into a high-anxiety asset rather than a reliable inflation hedge. In that scenario, risk premia widen and capital costs climb. For retail players, the message is balance and education. Don't chase peak volatility. Instead, consider diversified exposure through broad mining funds or a barbell approach combining steady steel demand plays with tactical nickel bets via matured ETFs. Use risk controls like position sizing, stop losses, and clear entry thresholds. Follow key indicators such as stainless steel output, battery cathode trends, and refinery throughput rather than headlines. Stay mindful of costs, learn the metals value chain, and use dollar cost averaging to smooth entry. If you're drawn to leverage, pair nickel with less correlated assets like copper substitutes or timber. Patience suits patient money. Looking ahead, nickel should settle into a more orderly drift, with episodic spikes when supply lines tighten or demand upgrades surprise. Investors can expect a multi-year cycle shaped by stainless steel production, EV battery chemistries, and fluid policy measures in major consumer markets. The price path will reflect not only mine output and refining capacity, but also the willingness of financiers to fund new projects. In practice, disciplined exposure, diversification across related metals, and a focus on cash flow resilience will serve subscribers better than chasing headlines. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.